Hello, 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 and we are going to be jumping into chapter 6 of The Divide today, talking about trade. So, as a precursor, let's first map out some of the economic changes that have happened over the decades in over the last century or so, and beyond in some of these slides. So here is a slide mapping the income inequality inside a few countries in the global south. South Africa, Indonesia, Argentina, India, Colombia, and China. And you can see that for the majority of these countries, there was an increase in internal inequality uh, that then started to decrease in the 50s, 60s, 70s, and then started to increase again starting in the 1980s. And if you zoom out to the globe as a whole, these internal patterns within the global south are true globally as well, as a whole, if you take the globe as a whole. So you can see that income inequality for the globe as a whole really started to skyrocket in the height of colonialism in the 1800s, and then started to peak, especially right before the stock market crash, went down a little bit after the stock market crash, and then back up again after World War II. And after we entered the era of developmentalism, in which many countries in the global south were gaining their independence and were redistributing land and nationalizing resources that had been co-opted through colonialism, and doing all sorts of poverty relief measures. There started to be a great drop in income inequality globally during that era, from the 50s through the 60s and the 70s, and it started to increase again as we started to see this era of coups and assassinations, and then especially started to increase and hold steady in the 1980s when we entered an era of neoliberalism in which the IMF and the World Bank started to do their thing with debt and with structural adjustment plans. So this particular map or graph of global income inequality compares the top 1%, the wealth of the top 1%, with the wealth of the bottom 50%. And it's a pretty stark shift that is brought about by the era of liberal capitalism, and then Keynesian capitalism decreased it somewhat, and then neoliberal capitalism took it back up again. When you compare the top 0.1% to the wealth of the bottom 50%, the contrast gets even starker. So you see this major increase in the wealth of the top 0.1% compared to the bottom 50%, right before the stock market crash. And then you see a really stark decrease in that era of developmentalism when new countries started to emerge, and then a sharp increase again as the era of neoliberalism took back over and shifted countries back into the places that they had been slotted into under colonialism. If you break down this wealth distribution by the top 1%, the bottom 50%, and the top 0.1%, you can see that the top 0.1% came to own more wealth than and take more of a share of income. Sorry, this is income specifically here. They started to take a greater share of the global income in the 1800s, mid 1800s, and that stayed true. So not the top 1%, but the top 0.1%. That stayed true until the era of developmentalism, in which the bottom 50% started to regain their position in terms of income inequality, and then lost it again in the era of neoliberalism in the 1970s and onwards. So it's not that the global distribution of wealth or the global distribution of income has always been the same. It's changed over the decades in different eras of economic and political policy. But in the era in which we are today, in 2019, the United States owns the lion's share of the world's wealth, more than any other country, and per capita, far more than any other country. So this wealth income inequality that is true for the globe as a whole, if you compare everyone in the globe together, came out of particular historical factors. So what have those been? One of them, of course, that we just covered in the last chapter is the structural adjustment plans. So let's review really quickly their elements and a few other questions. So what are the elements of structural adjustment plans? The policies are, of course, the liberalization or deregulation of the economy, fiscal austerity, that the government stops spending on social needs like education, like infrastructure, like medicine, like poverty relief, like general services and infrastructure. And the third being privatization. So selling off natural and national resources to the private sector, and selling off services that the public sector, the government, provides, selling those off to the private sector to provide instead. So this would be selling hospitals, selling schools, selling oil fields, selling forests, et cetera, to private business people. These structural adjustment plans are imposed and have been being imposed for decades by the International Monetary Fund, the IMF, in concert with the World Bank. And they're usually implemented in the global south or in countries that are financially struggling. Their economic priority is loan repayment, so that the loans that have already been taken out by those countries, they become the top priority, as opposed to providing for the people in that country. Instead, it is getting the interest and the interest on loans paid back to the banks that hold those loans. So what's been the primary outcomes of structural adjustment plans? Well, as we just saw in the slides I just showed you, one of the primary outcomes has been a rise in income inequality. We've also seen a rise in general poverty. We've seen a decrease in health services. Therefore, we've seen increased health consequences and educational consequences. And more importantly than anything else, what we have seen, which is the opposite of what was promised, is we've seen slower growth. So countries that have implemented the IMF's structural adjustment plans have seen their growth slow down, their economy slow, and they've become poorer in relationship to the countries that are lending them this money, in large part the United States. Okay, so in this chapter, we are going to be talking about global trade and various facets of how global trade is administered in the era in which we live today. And a big facet of that, of course, is the World Trade Organization. We're also going to be looking at what market liberalization under both the structural adjustment plans and also the rules of the World Trade Organization have done to countries. So market liberalization is the undoing of tariffs, the undoing of subsidies, the undoing of labor and environmental regulations, and the freeing up of capital markets and the decrease in taxation on the corporate sector, so especially on foreign investors. So we'll get into each of these as we go forward. We're also going to be looking at the impact of changing laws around the international patent system, and we're going to be looking at free trade agreements as well as international investment disputes, which take place in the ICSID. So that's a little overview of what we're covering going forward. Just a reminder about the Bretton Woods Conference in 1944 that set in place the institutions that we've been talking about in the last couple of chapters. So we've already talked about the International Monetary Fund and the World Bank, which were established in the Bretton Woods Conference following World War II. and were created by John Maynard Keynes, Keynesianism, as we talked about in the last chapter, whose economic vision was to stabilize markets and to create demand so that people actually have money in their pockets to be able to buy things so that the capitalist economy doesn't ground to a halt. So two of those organizations were the IMF, which was focused on stabilizing global monetary policy to not allow one country, through a problem of speculation, through the boom and bust cycle that is so natural to capitalism, would not create a domino effect for the rest of the world, in order to avoid future global economic crises. And this organization, as I've mentioned before, is always, 100% of the time, headed by a European. The second organization, the World Bank, was set up initially to fund development in poor countries, with a goal of ending global poverty. And this is an organization that's always headed by an American. Now, the third organization or really this was an agreement that was established during the Bretton Woods Conference under John Maynard Keynes, was the General Agreement on Tariffs and Trade, the GATT. So it was a set of negotiations that took place to bring down tariffs to favor the possibility of more global trade so that prices would drop. Because one of the biggest problems in that era, leading up to World War II, and in fact in some ways causing World War II, you can say, was hyperinflation. And inflation was in part driven by tariffs that were not very carefully crafted. So the GATT was established to sync up the needs of various countries who were trying to lower their inflation while still protecting their industries. Now, Bretton Woods Conference really was replaced in many ways by a reversal of many of these positions by both the IMF and the World Bank in the 1980s under the era of neoliberalism, which was, as I mentioned, brought in with Margaret Thatcher in the United Kingdom and with Ronald Reagan in the United States. And at this point, the IMF shifted its orientation and its focus on getting countries to repay their foreign debt. So instead of focusing on stabilizing the global economy, it instead became a debt enforcement agency that went around making countries reorient their economies in such a way that they could repay their foreign debt. And the World Bank in this time was reoriented as well, and it changed its set of policies that it was focused on to instead create loans for large-scale industrialization projects in countries in the global south, but that these loans were largely taken out to pay companies in the global north to come and build massive projects in the global south, so that the profit largely went to countries in the global south. And those two organizations together have been known as the Washington Consensus, since they're both headquartered in Washington. Now, in the same era, the World Trade Organization was created to replace the GATT, the GATT, that I mentioned from Bretton Woods. And it was started in 1986, and it set up rules of global trade. This is the one of these three organizations that is not centered in Washington. Instead, it is headquartered in Geneva, Switzerland, and it creates a single system for global trade. Not all countries, you don't have to sign on to participate in this single system, but if you want to trade globally, you have to agree to the rules of this single system. So it imposes and standardizes a set of rules on all countries that want to play ball in global trade. And the way in which it operates means that its decisions are enforced by judges in courts, and they allow countries to bring sanctions against each other. So I will come back to that in a minute. Unlike the IMF, which is always headed by a European, and the the World Bank, which is always headed by an American, the heads of the WTO have been people from a few different kinds of countries and different regions in the world. There have been more Europeans than anything else, an Irishman, an Italian man, a Thai man. But there have also been men from New Zealand and from Brazil. But most recently, and until today, we've had our first woman heading the WTO. She also happens to be a woman from Nigeria, so sub-Saharan Africa, first time ever. And so this is somewhat of a big deal. We also have the first woman who's heading the IMF right now as well, although she continues to be European. She's at least not the same as all her predecessors in the fact that she's not male. Okay, so the WTO, the World Trade Organization, that was set up in the 80s and really got going in the 90s. What does this organization value? It claims to value free trade, and the version of free trade that it attempts to implement, it claims, is that of David Ricardo, the 19th century British economist, the famous liberal economist, who came up with this idea of what he called comparative advantage, where he claimed that it makes more sense for countries to offer to the globe the things that they are best at making. So rather than attempting to create everything for yourself, instead specialize in what you're good at and then trade that on the global stage. And ultimately, that will do your economy better than trying to do a little bit of this and a little bit of that. So it's a theory of specialization, that countries should specialize. And it's also a theory of what you're naturally endowed with or what you're already good at. So it naturalizes the idea of where your position is on in the global economy. This theory of David Ricardo's was updated in the mid 1900s by some Swedish economists with what is called the Heckscher-Ohlin-Samuelsson model, which talks about comparative advantage from Ricardo's ideas in terms of relative endowments of factors of production. And those factors of production, according to this theory, are land, labor, and capital. Basically is a very similar theory, which is it states that some countries are rich in capital, some countries are rich in cheap labor, and countries that are rich in cheap labor will do best to just focus on offering to the globe things that can be made with cheap labor, things that can be accomplished with cheap labor. And those countries which are rich in capital should focus on the financial markets. They should focus on investments. They should focus on being the banks for the rest of the world. And that in this kind of a doing what you're already good at or what you already have in your pocket approach, that will be the most competitive advantage for each country, and that they'll do better by, like Ricardo said, sort of sticking to what they're naturally already good at based on these factors of production. So having read the chapter, you know that there are some blind spots here. So go ahead and think through what's wrong with, if you're asked on the exam, what is wrong with the Heckscher-Ohlin-Samuelsson theory or David Ricardo's theory when you try and apply it to global trade? What would be your answer? So there's several problems, but it turns out that the Heckscher-Ohlin-Samuelsson theory has not really been very predictive. It hasn't played out the way that they predicted in terms of what's good for any country's economy. So they said stick to what you have an abundance of. If you have an abundance of cheap labor, focus on providing cheap labor. If you have an abundance of capital, focus on capital investments. But that hasn't actually helped poor countries get less poor. In fact, it has instead naturalized or ossified, that is like ossified is to become like a bone or to harden. It's hardened that system in place rather than helping countries through some sort of competitive advantage move out of the poor position they're already in. So these theories make it seem as if it's just sort of natural that Papua New Guinea has no capital, so to speak, and that a country like the Netherlands has lots of capital. It's just natural that Brazil should be producing lots of sugarcane and soybeans and gold for the global economy, whereas California is producing AI and designing chips and designing iPhones. That is a natural position, and that therefore Brazil should just focus on sugarcane, keep where it's at. So with this theory, not only does it uh, keep countries where they're at, but it tells them basically a lie that by focusing on where they're at, they'll somehow get out of the position they're currently in, and that they're in that position through like no fault of anyone. It just happens to be the way that it is. The reality, of course, is that, as we know from developmentalism, if a country that has been harmed through a long history of being kept down through colonialism and through invasions and through having its ports under siege, all of these sorts of pressures that have kept it slotted into a particular spot in the global economy, the world system. To get out of that, you have to actually then protect the economy and protect innovators within that economy in ways that will allow them to develop such that they can ultimately compete with these already highly developed industries from other countries. In order to do that, you create a shell of tariffs, you infuse a lot of subsidies to get them going. You create capital control so that the money that gets invested in them cannot easily be yanked away. You also invest in education to build up a population that can participate in taking the economy forward, and you invest in a lot of infrastructure. These are all ways in which you can help a country, an economy that has been held back through colonialism or neocolonialism. You can help it overcome those wrongs rather than focusing on where it's already been slotted through the history of colonialism. Instead, get past that by doing the same kinds of things that the United Kingdom and the United States did for their own economies, which were tariffs and subsidies and capital controls and investments in education, investments in infrastructure. All these things were necessary for these wealthy economies to get where they are today. And these are the things that are necessary for countries in the global south to protect their innovators in ways that will allow their economies to move forward. As we know, all of that has been done away with by the structural adjustment plans of the World Bank and the IMF. They have disallowed investments in subsidies and in infrastructure and education, and they've disallowed tariffs, and they have disallowed other forms of protectionism and taxation. Another big part of the story of what has undone the developmentalism that would create the protectionist bubble to help economies grow in such a way that industries can ultimately compete with much more advanced industries around the world. Another big facet of that has been the WTO, the advent of the WTO. So that when this organization, the World Trade Organization, got established, it created rules that made it really difficult for these emerging economies to continue to get ahead. So the WTO had 164 member nations. It today is the governing body for 98% of global trade. So the United Nations doesn't really govern global trade. And many countries themselves don't really end up governing their own global trade because it is the rules are given to them by the WTO. The WTO purports to create a level playing field by making all countries reduce their tariffs and subsidies to the same levels. But the idea of a level playing field is kind of ridiculous, that you could just change the rules and that the rules somehow would make things fair. When you're talking about giant economies, highly advanced and well-developed economies, going up against these very underdeveloped economies that have been hobbled by colonialism and slavery and neocolonialism for centuries. So you can make everybody change, you can make everybody play by the same rules, but if those players are very different sizes and very different capacities, like making them play by the same rules is not fair. As it says in the book, it's sort of like having we'll do an American, like having an NFL player come up against a little, middle school flag football player. Yeah, they might be playing by the same rules, but their capacities are so different that the same rules don't make it fair. So the WTO is also the other important part to note. Just like the IMF and the World Bank, the budget is contributed by member nations. And so their control of that organization is also proportional to their share of international trade. So again, the bigger economies have more say in how these rules get written than the smaller economies. So everyone's playing by the same rules, but who writes the rules and who the rules are good for are and who even if you are playing by the same rules, who's the bigger player, make this all not at all a just or a fair system. So these rules that are made by these member nations are continually rewritten, and that process itself is part of the problem, as I'll explain in a bit. The way in which there is enforcement of these rules is if one member nation does not obey the rules that have been voted on by all of the member nations, then the country that is being harmed by the rule breaking can sue the country that is breaking the rules in court. And if they win in front of that court, then they are permitted to bring sanctions against the country that broke the rules. So sanctions are the enforcement mechanism used by the WTO. Okay, so as I mentioned, this is kind of ridiculous to think that by saying everyone's going to reduce their tariffs to this level and everyone's going to reduce their subsidies to the same level, and then we're going to have free trade as a result of like the same level of tariffs and same level of subsidies all around. To say that that is somehow the equivalent of a level playing field when you have really different kinds of powers at play, and when certain powers have more clout in writing the rules in the first place is rather ridiculous. So let's talk about the specifics of that ridiculousness in terms of how the WTO operates in addition to free trade. If you can think through the ways in which you read in the book, ways in which these rules play out and what the problems are, go ahead and pause and write those down, and then you'll be prepping well for the exam. Okay, so one of the major problems of how the WTO operates in specific is the fact that it has green room meetings. And the green room meetings are special secret meetings held by the G7. Remember, we talked about the G7 earlier. It's the group of 7. They are the wealthy, powerful countries who get together and make decisions in these behind closed doors. They decide on their trading positions, their negotiating positions with each other first, and then they come in against everybody else already with their plan of action in place. So these green room meetings have been a means for them to get their rules in place, and it allows them to operate sort of like a gang against everybody else. And none of the poorer countries are permitted to enter the room during the negotiations when this takes place. They've been escorted out by the security when they've tried to come into these green room meetings by the G7. Another one is that this is a pay-to-play system, so that, as I mentioned, these negotiations, these rules to world trade are constantly changing. So there's this constant need to have representatives of your country there, speaking on your behalf, voting on your behalf, negotiating on your behalf, like as a all year round proposition. And for many countries, this is too expensive of a proposition to think about buying or renting a whole bunch of apartments or paying for a whole bunch of hotel rooms year round for enough staff that they would also then have to give salaries to be there, to be able to negotiate in any sort of meaningful way. It's more than their economy can bear, particularly because through the IMF they had their budgets readjusted so that they're not allowed to spend on things like staff that could then go to negotiate for them at the WTO year round. So it's a too expensive a proposition for poorer countries very often to be present in large enough numbers and in meaningful enough a way to make their voices heard in this system. Also, as I mentioned, the enforcement mechanism is suing in a court and then winning that lawsuit and putting in sanctions. So the think about your own experience in your life. Like if you were to try and sue a company that you thought was harming you, that was a multinational corporation, very wealthy, how likely would you fare in that court process, given that the court is can be manipulated by more lawyers, better paid lawyers who have better facilities, so that the better the lawyers you can pay for means is directly related to the kind of result you get from the court hearing. So the prospect of poor countries going up against rich countries and all of their very expensive lawyers, their teams and teams of lawyers, means that poor countries very often cannot win the cases that they would need to win in order to bring sanctions, which is the only mode of enforcing the rules that the WTO has set. Because of this difficulty with getting a win in a court of law against a wealthy country with its many expensive lawyers, and also because of the difficulty of getting any enforcement through sanctions, it's really easy for wealthier countries to cheat on the rules of the World Trade Organization. So, for example, the WTO sets particular limits for subsidies and tariffs that can be put in place in support of any particular industries, and yet the United States and the European Union, they ignore the rules on subsidies for agricultural products, and they pour billions and billions of dollars into subsidizing farmers in both the United States and Europe in ways that then make put their scale on the market, put their finger on the scale of the market for these agricultural products in ways that poorer countries can't afford. So, for example, cotton, because the United States subsidizes cotton so heavily, cotton farmers, overall world market in cotton is about 10% lower than it would be, the price. And that 10% is not an amount that can be afforded by poorer countries. It's something that could be afforded by wealthier countries. But there's no real reason, there's no real means by which poorer countries can get the US and Europe to stop breaking the rules in a big way, because they don't really have the means to get them to it's hard to get to win in court, and B, then you can't really get it to be enforced. So why is it so difficult to enforce these rulings, even if you do win in court, which in and of itself is difficult for poorer countries? It's because a tiny country, when it goes up against a massive country with sanctions, that those sanctions are really not felt by the massive country. So if the United States were to sanction Mali and Burkina Faso and some of the other cotton producing countries in Africa, it would really hurt those countries' economies because the United States can levy massive sanctions. But if Mali were to sanction the United States, it would be like a little mosquito biting an elephant. You can't feel it because the country's so small. So sanctions as an enforcement mechanism mean that wealthy countries can do what they want because poor countries can't harm them in a way that stops them from breaking the rules, even though they have signed on to and agreed to those rules. So we have already wealthy countries being more able to put the rules in place that they want in the first place in the WTO, and having a better ability to negotiate and having better ability to win legal battles. And then, even if it does come to it, the sanctions that can be brought against them don't really harm them if they're brought by a poor country. So really, when it comes down to it, the WTO enforces rules on poorer countries, and wealthier countries can just ignore what they dislike in the rules that get put in place by the WTO. Whatever they don't want to agree to, whatever they agree to but don't want to actually abide by, they just ignore. Another big problem with this whole process of the WTO's imposition of the rules of global trade is that just like with the IMF and the structural adjustment plans put in place, the WTO has also knocked down tariffs around the world. And whereas the IMF has had to do it country by country by country individually, the WTO, by creating global economic policies, has in one fell swoop brought down tariffs around the globe. And as we know, tariffs are important for protecting developing industries. But another really important thing about tariffs is that in a poor country, this is your primary source of quality tax revenue. It's an easy thing to tax, and it is a point of taxation that allows for more revenue than you can get from people in your country if they are particularly poor. You can't go around taxing really poor people. And so if you have a country full of really poor people, it's much better to tax imports, that is, put on tariffs, than it is to try and tax what people are producing for themselves at home. So it's when the WTO comes and says no tariffs or low tariffs and imposes that on countries in the global south, then they lose their tax revenue. And indeed, since structural adjustment plans and the WTO rules have come into place, poorer countries have lost about 70% of their tax revenue. And this has never been made up in other ways. So whereas everyone said free trade is going to be great, you're going to make more money and you'll be able to tax more because you can make more money. In fact, that's not true. It's just brought down tax revenue in countries in the global south. So it's meant there's nothing, these countries have less and less that they can spend on building up their countries and building up their economies. Another form of world trade rules that have changed over the years are patents. So patents, of course, are laws that are meant to protect something that you have created and innovated by not allowing anybody else to copy what you've done for a certain number of years. So if you've been very diligent in creating this cutting edge new thing, a patent comes into place to say, congratulations to you, we're going to give you this boon or this benefit of no one else being able to create the thing that you created for a certain number of years. At this point in time, though, patents have become another way in which rich countries continue to grow richer at the expense of poor countries. So first of all, let's just think through the logic of patents. and whether or not they are quite what they purport to be. So the idea behind patents is that if you create this system, it will then motivate people to innovate. The people aren't motivated to innovate unless they know that they can protect a certain amount of profit for themselves, and that the whole point of innovation is profit. You're not going to innovate if you can't have a profit. But in truth, this is a little bit more complicated, right? The whole system of innovation, creation, and research. There are other motivations than profit. Humans have created new things, innovated new things for many, many millennia that were not necessarily out of profit. Like the desire to solve a problem or the desire to help people itself is very often a massive motivating factor in producing something new and working hard to innovate something. So, for example, Dr. Jonas Salk, who was in the early part of the last century a researcher who created a system to vaccinate against polio. He made sure not to patent his research in order to make the benefits of his work more widespread. He wanted everyone to have access to polio vaccinations. And so he didn't want anyone to be able to keep it behind a wall of profit. But another thing that is important to understand about innovation and research is that a lot of the research and innovation that happens in this country happens at public universities, or at universities more generally, but paid for by public grants, research grants. And the people who are doing this work don't do it in order to own the profits for it. In fact, they don't own the profits. The profits are owned by the universities, who then usually sell it off to the private sector. So much of the innovation that happens on our campuses, again, for the love of knowledge and for the love of discovery and for the love of moving humans forward, but not for the love of profit. So when you have so much publicly funded research that is bringing innovation to your economy, in this country, then that gets co-opted and captured by the private sector that then makes profit off of it. So it's not, very often it's not that the private sector innovates in order to make profit, it's that other people innovate for other reasons, and then the private sector co-ops that and makes profit off of it. So there would be other ways in organizing the system that would still allow for rapid innovation that are not about the profit factor. Also, you'll note that if it's only if it's another reason why companies often say that they need to have patents to protect their research so that they have enough money for future research, that would make sense if they were pouring their money back into future research, but most of their money goes back into shareholders, or it goes back, they spend far more on marketing than they do on research. So the high profits that are shielded by patents are questionable on several levels. When it comes to the recent patent negotiations and rules, there is something called TRIPS, the Trade-Related Aspects of Intellectual Property Rights, which is an agreement put in place by the WTO. So prior to TRIPS, patents were allowed to be about 13 years long in the late 1800s. Starting in 1975, they were increased to about 17 years long that you could have a patent on something. But after TRIPS, it became 20 years. So the length at which a company can keep its product to itself and not allow anybody else to make a copy of it, and therefore it can set the price for that thing, that has been steadily increasing under the WTO. And since TRIPS, developing countries are now paying an additional $60 billion annually in licensing fees to multinational corporations, especially those that are in the medical field, for life-saving medicines. So TRIPS has really changed the equation. Whereas poor countries used to be able to create generic knockoffs, TRIPS has made that much more difficult. And that's been even expanded since 1990 under TRIPS with TRIPS Plus, in which through bilateral agreements between countries, these patent systems and patent lengths have been getting ever longer to make it more difficult for countries in the global south to make generics of the products coming out of the global north. In addition to medicines, another important thing to understand about patents is in relationship to GMOs, genetically modified organisms. A lot of people are afraid that the trouble with GMOs is that GMOs are somehow unhealthy or dangerous for your body because they've had their DNA changed. That's not in fact true. That's not the worry with GMOs. The worry is that a lot of new seeds that have been genetically modified have been created specifically with an eye to improving the profits of the companies that own them. So they have been made in ways that they cannot be reused. So naturally, of course, if you plant something and then it grows and it gives you more seeds, you should be able to take those seeds, replant them, and regrow. But through the GMO process, the companies have created seeds that cannot, in fact, create new seeds after they've been planted, so that then the farmers can't save seeds and plant their own seeds. They have to go back to the company and buy more seeds every year, whereas before they could have planted and then saved some and planted and saved some. Now through the GMOs, they have to go and get them every year. They've also created other kinds of designer seeds, not just these that don't produce seeds of their own, that are specifically tied to other products of that same company. So there are some seeds that will only grow if you pour certain chemicals from that same company or weed killers from that same company. So they have created seeds that are genetically modified such that you must buy other products from that same company in order for that seed to grow. And although this sounds like, well, couldn't farmers and countries just like ignore these products and not use them? But in fact, through a lot of free trade agreements and the WTO and a lot of aggressive marketing, that in fact has been really difficult to avoid. And these kinds of products are now ubiquitous around the world and are causing all sorts of shifts in farming that make you much more dependent on the company and make a lot more money from the whole process of farming flow to a company like Dow or Monsanto. They have actually made it criminal in our country to save seeds. Farmers saving their own seeds and banking them has been made criminal. Like there are farmers who actually go to jail for saving seeds because Monsanto has been able to co-opt and Dow have been able to co-opt the legal system here, and similarly around the world. So these free trade organizations, these free trade laws, what they often do, in fact, is upend the traditional farming practices around the world of many farmers. Okay, another problem with the free trade era is what's called the investor-state dispute mechanism. So how it is that investors, multinational corporations who go around the world spending money to buy or put in local factories or create local mines, or etc. How it is that they are able to manage their disputes between them and the countries that they're in. So the first investor-state dispute mechanism was written into NAFTA, the North American Free Trade Agreement, which was the first free trade agreement outside the WTO. And written into Chapter 11 of NAFTA, there was a very obscure law that said that if any other country attempts to harm the profits of an investor corporation, that the corporation can sue that country. And it got picked up on by a company called Metalclad, which had a hazardous waste landfill. And the local government in Mexico that was overseeing this area, they wanted to close it down for all the environmental contamination that was leaking out into the local water supply. But when they shut Metalclad down, Metalclad took them to court, took the country of Mexico to court under Chapter 11 of NAFTA, and said that their profits were harmed, and therefore the whole country of Mexico would have to pay them for their lost profits. Something similar happened in Canada, where Dow took Canada, the country, to court for banning pesticides that were causing cancer. So when you think about this, it's not a company suing a company. It's instead a company suing a country, something that ought to be democratic, right? So a whole democratic group of people. And these agreements then are basically subverting the democratic process such that a company can dictate the rules to a country rather than a country dictating the rules to a company. So even if people are elected, they represent their constituents and make rules that are for the benefit of their constituents in terms of labor regulations or environmental regulations, or how they want everything to develop. Under these free trade agreements, and increasingly under the WTO, then that company can now subvert that democratic process, that democratic decision-making and policy-making process, by claiming loss of profit and tell them, no, you cannot regulate labor or regulate the environment in these ways because of our claim to profit. We must be able to have profit. So it makes the companies sovereign rather than the nations sovereign. Okay, another set of problems that has been put in place and exacerbated by the structural adjustment plans and the WTO and free trade agreements, which are bilateral, trilateral agreements, is an increased reliance on hot money. So under Keynesianism after World War II, and really after the Great Depression, but in response to the Great Depression, and then globally after World War II, there were a bunch of rules put in place to make it difficult for speculation on the market to create a lot of financial risk that could then destabilize a local economy or the global economy, because they're linked, of course. And a lot of those regulations were making it difficult to move money around really quickly, to chase profit here and there. And instead if people were going to invest, they were going to have to keep it steady, keep it there for a certain amount of time. And they would have to make a lot of account of themselves and be approved to remove their money if they were going to remove it in ways that would make it easier for banks to be steady, for development to take place, for long-term decisions to guide investors rather than short-term profit. Under the neoliberal system of SAPs, WTO, and FTAs, a lot of those checks to keep things slow and steady and stable have been taken off. And instead, we've seen an era of what's called hot money, where it's easy for speculators to move money into a country and move it out, to be able to chase money here and there, invest and then pull your investments out. If your factory here isn't making as much as a factory over there in that country, could you pull money out of that and put it over there instead, so that people suddenly lose their jobs in this country instead of that country. But also particularly with money markets. So investing in one country's currency and then moving it to another country's currency and bopping it around. So with money markets, particularly, the liberalization that was imposed by the IMF was what caused the Asian financial crisis of 1997, when the Thai baht, which saw a bunch of influx of international investors who then pulled their money out quickly. That then led to the Thai economy falling, which led to a domino effect in Asia that saw a bunch of countries go down. So liberalizing the money markets has meant that we have seen riskier kinds of financial situations, higher returns for the investors, but difficulty with creating a stable and well-developed economy within the countries in the global south. Another way in which, and major way, in fact, in which countries in the global north, multinational corporations, are able to take advantage of these new systems of both deregulation and structural adjustment plans that take money away from something like investing in public employees who can regulate business, but also the IMF and the WTO very often demanding from these countries that they not regulate trade. It's meant that it's become really easy for multinational corporations to just lie about, cook the books, just lie about what they're making. So they keep put invoices in that are not, in fact, accurate, which then allows them to secretly send money that they're making to offshore accounts. And we now today, as a result of this era of neoliberalism, we have billions and billions and billions, actually now it's up to trillions of dollars of money siphoned out of countries in the global south and the global north that is kept in tax havens, that is never taxed, so that it can then never make a contribution to the country out of which those profits were extracted. In addition to misinvoicing, there's also transfer mispricing. So this system of global trade has made it really easy for countries that have high taxes to have their taxes avoided if a company has a subsidiary in a low tax country. It just sells to itself within a different country in ways that allow it to avoid taxes in the country where it made the profit. So as much as 60% of world trade actually takes place within MNCs, so multinational corporations selling to themselves so they can avoid taxes in high tax countries. So it's related to misinvoicing, which is just like lies, cooking your books. Transfer mispricing is selling to yourself. So yeah, these tax havens have also been really facilitated by the rules of world trade that have bolstered the possibility of stashing your money in countries that don't tax it in ways that cannot be detected as easily now that we have made we've liberalized trade and deregulated red tape in countries that would like to tax money. So just recently I heard the economist Kenneth Rogoff estimate that about 20% of global GDP is actually hidden in tax havens. So 20% of what we are producing as a globe is secretly and illegally kept in tax havens never gets taxed. In 2016, so a few years back, the estimates put the figure at about 36 trillion annually. And in 2018, the estimates put the annual cost to governments in lost taxes at 500 to 600 billion a year. So much higher today than then. So this system of global trade, liberal trade, free trade, which is basically deregulated trade, makes it really difficult to tax money that could be taxed that then could be coming to help the world as a whole do better in so many ways. So here is a map of capital flight. So money flowing out of countries that could very much use the money. Particularly as you see, the darker it gets, the higher the levels of capital flight. So Nigeria, much of the west coast of Africa. So this is Ivory Coast, Iran, Argentina, Venezuela, Mexico. You're seeing countries with very high levels of capital flight. And then you can also see all of the tiny little tax havens around the world. But you might think of tax havens largely as being associated with tiny island nations, but some of the biggest tax havens, in fact, are not, as I'll show you on the next slide. Messed that up. Okay, I guess we're skipping a slide. All right, so what does free trade look like from the perspective of the global south? If we're going to kind of recap all of this, the country I was going to show you that was the highest in terms of its percent in terms of tax havens is actually the United States. So Delaware and Nevada and a bunch of other places are tax havens, just like the Cayman Islands, like the British Virgin Islands. There's United States is one of the biggest tax havens, or areas of the United States are some of the biggest tax havens. All right, so what does free trade look like from the global south? Well, the IMF and the World Bank backed debt is something we've already talked about, massive debt that has been created in the name of free trade. We have all these structurally adjusted economies that have sold off most of their own assets, that have abolished corporate taxes and tariffs and capital controls and land reforms and environmental and worker protections. We've seen customs tax really discouraged in the form of tariffs, and therefore there's a really low capacity to implement programs to reduce poverty or to fight illness or to create infrastructure or stimulate growth in other ways. And then we've seen this system created, the World Trade Organization system created, where poorer countries have very little input because they don't have much market share. And then they come up against these highly industrialized and mature foreign industries in the name of free trade in a level playing field that they can't actually compete with. And they also face these really highly subsidized foreign industries, particularly in agriculture, particularly in corn and soybeans and cotton. Those are hugely subsidized. And so then these poorer countries are fighting each other in a race to the bottom to slash their taxes, to attract foreign investors, to change all of their policies in terms of protecting environments or protecting their workers in order to attract foreign investors. So things are actually they're racing each other to the bottom. And then these trade courts can't do much to protect them because it's all sanctions, and so it's all your economic weight again is what matters. Then we have these investor dispute mechanisms that make it really difficult for sovereign nations to protect themselves from multinational corporations. And then ultimately you have this ongoing political intervention if you want to create an alternate system. So any country that wants to stand up to this global system still ultimately is under threat of being destabilized, being invaded, if they don't play by these rules. That's an ongoing threat, not one that is off the table, as we know. Okay, so we have this story of, like some countries being rich and other countries being poor because some countries they have this hardworking culture and they have, they've made the right decisions in terms of investing right, building good infrastructure, fostering an educated populace. They've just done it right, and so therefore that's why they're ahead. But when you look at the historical reality, many of the countries who have done it right, what they have actually done is actually push down countries that were starting to do better through similar kinds of policies, but forcing them back into positions they had been in before, deindustrializing them again, and through structural adjustment plans and WTO agreements and free trade agreements, making it really difficult for them to gain a position like that of the United States or the United Kingdom. So these are not the only factors at play in why some countries are rich and some countries are poor, but massive foreign debt imposed through high rates of return, high interest rates, and structural adjustment plans, and unfair WTO system, and unfair free trade system. All of this is the lion's share of why certain countries are not able to get ahead, because they are literally kept down by these policies. Okay, so a little bit of a hiccup here or there with this one, but that is the chapter for today. And see you for the next one, 8 to 9 in just a minute.